Welcome, everybody, to the SNN Network Canada virtual event. I'm your host, Robert Kraft, and thank you all for joining us today. It's my pleasure to introduce our next panel here at the event. This panel is titled Dual Listing, What You Need to Know from an Accounting Perspective. And this panel will be moderated by Neil Levine, the chair of the SEC practice at Friedman LLP. And with that, Neil, take it away, my friend.
Thank you, Robert. Great to be back with SNN again. So good afternoon, everyone, and welcome to the virtual conference with the accounting panel. What you need to know from an accounting perspective regarding dual listings. I'm honored once again to be the moderator of another SNN event. Friedman LLP has been the lead sponsor for SNN for close to 10 years or so in regards to the in-person and virtual conferences. First off, I'd like to thank my esteemed colleagues who I've been fortunate enough to discuss the current events that are happening as it relates to dual listing issues for Canada, the US, and other countries. Each of the panelists in a few minutes can have a few minutes or so to tell us who they are, a little about their firms, etc. So I'm Neil Levine. I'm the co-chair of the SEC practice for Friedman LLP since 2014. We're an accounting firm of over 759 employees, formed in 1924, some 96 years ago. Our SEC practice has grown to number 12 in the country in the amount of registrants that we service. We handle public companies on all the national exchanges, the US OTC Markets Group, and the Canadian exchanges. We also audit private companies contemplating going public. We have a large audit and international tax presence. For example, as it relates to international audit, we are number 4 in bringing registrants from China here to trade on the American exchanges. We are also the largest independent firm in DFK, which is a world body of audit firms that have 93, in 93 countries, we have 441 firms to handle both domestic and international needs. So Friedman has also affiliated with 20 firms in Canada with 595 people, should we need them. So now let me introduce my panelists for today's discussion. From Friedman LLP, my partner, part of the SEC group, is Sokhi. So Ro, I will introduce you. And then we have Jon Repka from Paro. And Jon is with a managed professional services firm, which we're very glad to have today. Normally, we just get audit firms, but we invited Jon because there is a major need for services that he does provide. So with that, Ro, go ahead.
All right, thanks Neil. So my name is Sokhi. I'm a partner at Friedman, and I'm part of the, as Neil mentioned, the SEC audit practice. And what that means is, we service clients that are publicly listed in the United States, or we also service private companies that are looking to IPO in the near future, either through a traditional IPO or through a SPAC transaction. And these types of clients essentially give us quite a bit of exposure to complex debt and equity transactions that they go through. I mean, they've got complex organizational structures that require VIE analysis. So we're well poised to service clients in that space. And a little bit about myself, I've got about 15 years of experience. The bulk of which was at a Big Four accounting firm where I did very similar work, worked on public companies in the technology space, as well as companies looking to eventually go IPO. So I think, the folks that are watching this, webcast, I think we should be a pretty good fit for you.
Great. Thanks, Ro. John, take it away.
Absolutely. Thanks for the intro, Neil. Jon Repka, I'm the VP of Growth at Paro. The way I'd like you all to think about Paro is as a platform comprised of the best, brightest, or our claim to fame, the top 2% of finance and accounting freelancers in the US. And we have a rich history of partnering with partners like Friedman. What we typically find is that their areas of expertise in SEC registration, audit, tax is a really brilliant complement to where we thrive, which is on the more operational side of the business. So think of Paro as project-based and fractional work. Projects like implementing an ERP system, creating some FP&A dashboards, M&A advisory, and on the fractional side, think long-term support to micro, small cap, and mid-market companies that simply don't have a need for, say, a full-time CFO, a full-time controller to run month-end close, budgeting, et cetera. A little bit about me, I've been at Paro for 5 years now. It's been a wild ride going from the 5th employee to now looking around. We have over 150 full-time employees and coming up on 1,000 vetted freelancers in our marketplace. Happy to report we raised our Series B over the summer at a healthy 9-figure valuation. And the majority of that growth has actually been driven by public companies. The majority of our experience has been in the microcap and small cap space, ton of work on the OTC, also have exposure to NASDAQ, New York Stock Exchange, select international exchanges as well. And so when the opportunity came up to put our heads together with Neil, Ro, the team at Friedman, seemed too great of an opportunity to pass up. And I'm excited to share a little bit of the more finance and consulting side of this world. I actually kept my teeth at the Big Four as well, but on the consulting side of the house. So I think it should be a fun discussion with Ro.
Great. Thank you, John. So I would just like to say that I guess we've done maybe 5 or 6 of these virtual conferences. And this is for John. We've got a ton of business and leads from this conference, and we would like to continue, to build a great relationship with you and your team, because for the people listening out there, there is a major shortage for guys like, Paro. There's a lot of guys that opened up, they said they could deliver, and they really haven't delivered. So you guys have a great opportunity to ride with us, and we'll be looking forward to meeting each other and the people out there in person sometime in April, where we get to actually do one-on-ones. So just for John's benefit, we do contact the 68 people who are coming to the conference, and if something comes our way where they're looking for needs for what you provide, we'll certainly put you in that position. So anyway, let's start off with a couple of questions. Ro, I have a question for you, but I don't want you to take up the whole show here. So we want to talk about, we want to talk about what are some of the considerations for Canadian companies that they will need to assess when listing in Canada and eventually taking advantage of the US capital markets. Now, the people out there know that what we see is dual listings, and the show today is about dual listings, and most of the companies in Canada will dual list here on the OTC, and then they'll get they'll get financing or whatever they have to do, and they'll move up. So with that being said, I'm going to give you about 3 to 5 minutes, not to hog everything up, but what are some of the considerations?
Yeah, no, so look, it really depends on what direction the company wants to go, right? There's a ton of considerations that Canadian companies will need to make, and setting the stage early is going to be important, because those decisions will have cascading effects later on. So a company looking to go public in Canada, perhaps on the TSX stock exchange, something like that, would need to have financial statements that are in IFRS, and they need to identify a kind of a local auditing firm that is listed, that's that can do those audits. So many Canadian companies, especially historically, that have looked to go public in the United States have or taken advantage of the U.S. capital markets, have gone the route of listing in Canada, and then being on the OTC markets, and OTC markets being the over-the-counter markets, which are essentially it's not a centralized exchange. Essentially, it's shares being traded with broker dealers and that sort of thing. So just really quickly on the different types of the OTC markets, you've got the pink slips, pink sheets, which are lower, let's call it higher speculative, more speculation on those, and there's definitely much less reporting regulations and that sort of thing. So if you're already listed in a Canadian stock exchange, you may not want to go the path of a pink sheet. Then one step up, you've got the QB, and then above that you've got the QX, and QX is really more for the more established companies, and if you're listed in a Canadian stock exchange, you'll likely go that route. I do want to mention that a lot of companies have gone the route, and especially with how hot the NASDAQ has been, and the U.S. capital markets in general, especially if you're in a space where you're in technology or something like that, or like biotech, you may want to consider just listing directly on NASDAQ. There's some benefits there, and we'll talk a little bit more about that, but that's just some of the thoughts, some of the considerations that Canadian companies would need to have.
Great. So I mentioned, Ro, at the beginning of the show that companies hire consultants like Jon's company. So Jon, in what applications would a company hire a consultant like you guys to get them audit ready? Because Friedman, we can't do our thing unless we get an audit ready package from the company or a consultant for the company.
Yeah, we're in the business of making audits easy, making it easy on you as the auditor, making it easy and more cost effective on the company to complete the audit. A lot of this stems from a proper internal audit performed proactively, where you can have an independent, typically an ex-auditor, perform very similar testing, very similar evaluations of things like checks and balances to catch some of things that the ultimate auditors would catch, rectify this ahead of time, again, make this a more cost-effective and a more streamlined process. Also find a pretty consistent use case to prepare audit-ready reconciliations, any sort of work papers, make sure those are all ready to go for the auditors. And for companies that are a little bit less sophisticated in terms of their accounting org structure and development, even just writing and reviewing accounting policies, advising on internal control procedures, and just providing that review prior to the audit engagement can make this a whole lot smoother experience for everyone involved.
Excellent. So, Ro, once a company has an accounting package and they're looking to hire an auditor, so the question is, what does a company look for in an auditor, and why should they hire Friedman?
Yeah, no, that's a fair question, and I think Jon's input there, I think made is super important, right? You do need a company that will come in to help management and coach management through that process, because once it gets to the auditors, it's the timelines are typically very crunched, and there's a lot to get through there. But there's a lot to think about for Canadian companies that are looking to hire an auditor. Look, if you're trading in a Canadian market and you're under IFRS, sure, you can go ahead and find a local auditor in Canada and get the job done. If you're looking to take advantage of the U.S. capital markets and are listing so just real quick, if you're on TSX, for example, and then trading in OTC, you can keep your financials in IFRS. once you are once you're listed on NASDAQ, you're going to need to file. You're going to need to upgrade, let's call it, those financials to be in US GAAP. So that's when you'll need a company, you'll need a firm like Friedman, who's registered with the PCAOB, to do an audit. And there are not that many firms that are registered with the PCAOB. If anyone's ever been, reviewed by the PCAOB, it's quite an arduous thing. It's the bar is very high for those audits. And, so a firm like Friedman would be perfect to be able to get you that audit done, essentially. So, one thing that I want to kind of highlight is that if you're listed in the Canadian, stock exchange, your financials need to be in IFRS. Unless you're an SEC issuing company, then the Canadian regulations actually allow you to file, with the Canadian government under US GAAP. And that's when a firm like Friedman can come in and do your audit for the Canadian filing as well as the US filing, because that's when, essentially, if you have us come in after, right, you've got the local firm and then we come in afterwards, it is just when the costs just go up astronomically. So our recommendation is, go with a firm like Friedman, who is experienced with PCAOB audits. I mean, we're reviewed annually by the PCAOB. We've got the expertise, and you need a company that's registered with the PCAOB.
Yeah, and I would just to say also, Ro, with the IPO market, we did a $300 million IPO this year. We didn't get any comments. When you're working with bigger law firms and bigger accounting firms, I just think the regulators, they look at everything, but if somebody's going to raise $300 million, they want to be with someone they can trust. So with that being said, throw it back to Jon Jon, the pros and cons of getting fractional support or a company hiring their own people. Why don't you talk about that a little bit?
Yeah, one of my most passionate topics, actually. And I find that the common perception misses the most important point about fractional support. And that is that you can now afford a better, more experienced, more exacting standard of that talent. And I think people typically jump to the flexibility and the cost savings and the scalability, which are all well and good. But even in Ro's example of a company listing in IFRS, registering on the OTC markets, and now having to report in GAAP, that is not a skill set that you likely had in-house prior. And the flexibility to flip a switch and say, hey, we can now have that turnkey expertise in GAAP, add that onto our team structure in an ultimately flexible model that you are not committing to a full-time hire, it is truly invaluable. And then as we think about high growth companies, that scalability of, hey, I may need a full-time role down the road, but how can I bridge that? Fractional support, very useful way to bridge that gap, if you will. And then the cost effectiveness really shouldn't be ignored. That when you start taking out the benefit loads, the PTO, the severance pay, not only do you gain in terms of the flexibility of those models, you are ultimately paying a less total cost to serve. And that gap is even highlighted in major cost of living metros like the Torontos, the Vancouvers, the Chicagos of the world, where you can now leverage wage arbitrage and pull phenomenal talent from lower cost of living metros, giving that exact same quality bar, exact same background, but at a much lower total cost to serve.
Yeah, and Jon, the other thing is a company may have people in-house to do their accounting, but what they don't have the expertise, especially our Canadian friends, is drafting those financial statements to be acceptable under PCAOB and SEC standards. So that's something to rely very heavily on consultants, because that's a special animal. It's not like a tax guy can do that, or even a normal auditor. You have to know how to do that stuff.
It's really interesting, and that you bring that up. That was actually our entry point into the OCC market several years ago, that exact use case. And we've now support dozens of companies actively, purely from a quarterly and annual reporting standpoint. They've got great in-house teams, but that public actual reporting piece, not something that most CPA firms are able to offer. And it's something that you get what you pay for, and be able to do that fractionally with someone who's amazing at what they do, but not a full-time employee, makes a whole lot of sense for these small cap companies.
Yeah, and I'll just add that a lot of our small cap clients, they're can be very lean teams, right? And it's a great way to, hey, when you need this kind of a bigger team and whatever set of weeks, right? You can just kind of grab on and hook up with John, and now you've got a full team when you need it. And then after that, the project's done. You don't need it anymore. That's right.
And back down, particularly for those quarterly filers. It's pretty good system.
Yeah. So Ro, we're talking about dual listing, and most of the Canadian people, they do dual list and they end up on the OTC. But you had mentioned a little earlier that you could do an S1 or something. Like, so what are just some of the other alternatives that a Canadian company could possibly go public in the US?
Yeah, I mean, there's several ways you can go public in the US, and I'll just kind of go through some of the more popular ones and kind of maybe just talk briefly about some of the pros and cons. So the first is a traditional IPO where you file an S1 with the SEC. You'll get comments back, and you go through that process. The pros there are that the private company that's looking to go public is in control of the timing, right? Plus, there's you're following a more beaten path. Folks that maybe are in-house are more familiar with IPOs. The SEC is familiar with IPOs. So those are just some of the pros. So some of the cons maybe is that a little bit more expensive and it takes a little bit longer than some of the other options. So then you've got the reverse merger or reverse takeover, which was kind of booming maybe about 10 years ago or something like that. Again, the pros. So the way it works is the private company acquires kind of a small dormant shell company that maybe isn't operating anymore. And so what happens is, the pros there, again, the company that's looking to go public is in control of the timing, right? They can identify the shell company and make the acquisition. Some of the cons are that, some investors may be apprehensive about it because, there were some kind of, abuse, say a decade ago with some foreign investors, coming into the U.S. market, and the SEC actually delisted over 100 SEC public companies. So that's just something out there. And of course, there's a SPAC that a lot of people are hearing about and is all the rage these days. So SPAC stands for Special Purpose Acquisition Company, and what these are essentially investors invest money into a shell company that's publicly traded. And they're tasked with going out and finding private companies that can, would do well being public. The pros here are, it's generally a little bit cheaper than an IPO, a little bit quicker, right? So a lot of companies that are looking to take advantage of this hot market may find that a SPAC is the most attractive. The cons, there are a few cons. The first of which is that if you are a private company looking to go public now, sure, it can be quicker, but you do have to identify the SPAC itself. And, there's a bit of a matchmaking process that goes on, and a little bit of a courtship process, which can take some time. And, you may or may not get there. There may also be some changes that the investors may ask of the investor, of management. But of course, typically the lure of a a SPAC for a lot of investors is that, these private companies, they usually have really good management teams and they're usually doing very well. And the only thing that they are missing is the investment, the capital, essentially. And then finally, the con of the SPAC is that the newness of it. It's definitely this. So early in the year, as you may be aware, there were some restatements around the accounting of warrants, and then more recently the classification of some equity transactions, which really should have been mezzanine classified. And so the newness of this can be a con as well, and something that companies may want to think about when they're kind of deciding which path to take. So a lot to think about with all of these, but I think it makes sense to get in early, plan early, and then decide on the path forward.
Thanks.
If I can just reiterate one of Ro's points about the newness, the fun fact of these SPACs. I've never seen a dearth of talent like the last 18 months or so when it comes to SPAC expertise. On the audit side, on the prep side, those individuals are worth their weight in gold at this point. Just adding to the tight labor market that's already present pretty much across the entire industry.
Yeah, so I like to just, so I invested in 4 SPACs. I got to get off the beaten track. They are all dogs right now. I'm not going to go into it, but I wanted to tell you, regarding the SPAC, some of our competitors, they are so tied up in restatements. They're calling me and they're saying, Levine, I'm getting work from my competitors because, again, they're restating the SPACs. And there were, how many? 500 of them. I mean, it's crazy. But let's move on. So
definitely round 2 of restatements, which is amazing.
Crazy.
Now we have a ton of IPOs. We have a few SPACs, but from our perspective, I don't know what your perspective is, but
for us, it wasn't worth doing the audit of the SPAC. It was worth doing the audit of the operational company going into the SPAC. And, out in China, we might have maybe 4 or 5 very successful SPACs. But here in the US, if a company's going to raise $300 million or some big number, sometimes, they'll think they may have to go to a big 4. But anyway, Jon, we talked offhand and you were getting this concept, and I want to understand it a little better, of zero-based budgeting.
Yeah,
and
sure.
How does that tie into anything like with these Canadian companies or private companies?
It's
What that is.
It's a best practice. This is coming from a financial analyst, FP&A lifer, that is growing in terms of popularity. And I'm finding it is really kind of changing the face of financial planning and analysis. And so the general concept is, rather than the legacy way of budgeting, where you traditionally just take last year's budget, look at a line item level, what's the trend, what's the expectation for next year, gross it up, gross it down, drag to the right, there's your budget. It is a process by which you re-justify every cent of investment on every line item, every period. And if it sounds a little more resource intensive, it certainly is. And what I don't want to do is scare away any early adopters from saying this is going to take a whole lot more time, because it does not have to be all or nothing. You don't have to carve out an entire 12-month annual plan cross-functionally from zero-based budgeting. And where I've seen the most success is firms dipping their toes in the water with, say, their marketing spend or an events budget, and adopting the zero budgeting mindset, where you completely clear off everything that happened last year and you weigh every initiative based solely on the weight of its merits and allocate funds where there is the highest ROI or they're most in line with your strategic objectives. And this is no longer art or qualitative. There is science now behind this, that it is a more profoundly positive way to allocate your budget to the initiatives and to the investments that are going to yield the highest ROI. And this is something that I would love to talk to any of the attendees about, certainly divergent from the path of dual listing or even public company is just something that every function, every business, whether you're a brand new startup or a Fortune 500 enterprise, can take a page from.
Got it. Sounds interesting. I was just looking at a possible unification of two synagogues, and they gave me the budgets, and I was looking at the budgets and the actual. I'm like, well, why do you need all these other clergy members or employees when your budget is so different? So no one took the time to really go in and say, now that we're coming together, what do we really need? And that's for every line item.
That's a perfect use case, Neil. Thank you for bringing that up. And there's a school of thought to say, well, we can just mash the two together and consolidate them. But if you're willing to invest the time and effort to actually build it from the ground up, we see pretty phenomenal results consistently.
Got it. So let's talk about the new COVID variant. I don't like to bring it up, but I'm going to ask Ro. What has he seen this year? COVID-19, some accounting issues, working from home, whatever you want to talk about, Ro.
Yeah.
We have to bring it up because it's in the news again. And I think we're doing well here. I don't know. I think we did better than Canada might have done, but how are we doing, Ro? What's going on?
Yeah, look, the fact that there's another variant, right? And this is, I mean, when I first, when it was March of last year, I was thinking, oh my God, it's going to be 2 weeks and we're going to have to, we have audits going on, and now we're going on to 2 years. So, the challenges of COVID are real, right? And, there's lots of challenges, and especially, the first thing that comes to my mind is, there are just recoverability of long-lived assets. I mean, goodwill, going concern, all of these rely on, projected financial information. And, how can you reliably project financial information when you're just not certain when the pandemic's just going to be, when it's going to be over? So those are some of the challenges that we're finding some of our clients are going through. They're definitely just having to dust off the projections from the prior year and just revisit, like, those curves may not be coming back the same way or in the same trend line as they were, originally thinking. So those are, one of the, especially for an auditor, we're looking at impairments and going concern. Disclosures, right? I think the SEC is looking for more robust and not so boilerplate disclosures around COVID-19. If there's an impact to your company, management, SEC is expecting robust disclosures. And the final point that I'll make is, especially our, more further along public companies who are, testing under 404B around internal controls over financial reporting. Are there control deficiencies there that, maybe weren't a problem last year, but now that it's been 2 years and people are working from home and maybe, the eyes have been taken off of some of the controls, are there control deficiencies that are not being reported or they're just not being missed? Or are there changes in the process that management does not have appropriate controls over? So those are just some of the things that, we're seeing with our clients, and we just want to make sure that our clients are, anyone watching, just, keep cognizant of.
Yeah. So on that line, Jon, with the changes, let's talk about technology, infrastructure. What have you seen? I mean, we know we have to stay up, but it's like, how did you go out and maybe help somebody do an inventory? I mean, what kind of technology do you think the companies have to do to keep everything cutting edge and enhanced?
I mean, to really do this right, we have to step away from the existential, where if businesses weren't able to move most of their operations remote, whether that be video conferencing or payables or receivables, they're now out of business. And so we've taken care of the existential, but what we see is that we have not approached, or most companies, particularly small and mid-market companies, have not approached this holistically from the guise of true digital transformation, where how are we aligning not just our technology stack and the various tools that we've purchased and how they're integrated, but also with our processes and with our strategy and with the data integrity that's required to make all of those pieces sing. And when you think about it from, well, at least what I personally see as a business's most valuable asset, their people. Are you going to deploy your people in manual processes that are going to drive them ragged, introduce errors based on manual data entry, or are you going to build process flows that allow your people to be knowledge-based value adds, decrease the errors that come from a lack of automation, save that time, save that money, and deploy them for actual business and client value adds? It's kind of tough to overstate the impact that a proper tech infrastructure and proper digital transformation can have on even a small business. And we're seeing the demand for that specific application just go through the roof in the last 24 months or so.
Right. And I'll just add that, Friedman was so fortunate. I think it was February of 2020, before COVID really hit, we did a major upgrade where when people just had to work remotely or work from home, we didn't really miss a beat, which is crazy to even say. So, the firms like us and you who are staying up on this technology, it's really just the only way to go.
It's the only way. And I mean, we similar had the benefit of being a remote first marketplace for the 3 years leading up to COVID. And so even though we had become adept, 98% of our business was delivered remote, our HQ, our in-house team was still primarily on site. And so even for us, we're as well versed, I think, as you can possibly be in remote work. There was a learning curve. And so being able to share those insights now with clients as well, it's invaluable.
Yeah. Okay. Ro, we're going to move on to a topic that some of the Canadian companies who are dual listing here would, there's a distinction between, in the US, a smaller reporting company and an emerging growth company. And maybe you could just give a minute or two to differentiate between the two and how it relates to the reporting process.
Yeah, I'll go. I mean, it's very technical, and I'll give kind of a quick summary. So essentially, these are both ways that the SEC is kind of given ways to incentivize and encourage investment in in growth in our country. So the EGC, or the emerging growth company status, essentially what that is, and it's technical, right? It's a company has to have annual gross revenues of less than 1.07 billion and not have sold any equity securities in a registration statement. And you can keep that status for up to 5 years, given some criteria. And we'll get into why that's important, but maybe I'll just quickly touch on smaller reporting companies, the SRCs, which are companies that are smaller. So if it's a company that has a public float of $250 million or less, or revenues of 100 million or less, and a public float of less than 700 million. Now, we can guide you through that, right? Anyone kind of getting lost over with those numbers. But essentially what that means is if you qualify for these, these types of easements, let's call them, the SEC has allowed, less reporting requirements for these types of companies. So that includes less extensive disclosures in the 10K, including less disclosures around executive compensation.
So no, I want to interrupt you for a second. I've heard about this confidential treatment, or sometimes they can do a filing, one of these companies, and nobody knows about it.
Yeah.
Can you expand on? I mean, that's, you may have one of these Canadian companies that they want to get their feet wet. What's this confidential treatment all about?
Yeah, so the way it works, and especially if you're going a traditional IPO route, so the initial S1 that's filed with the SEC is confidential, right? So nobody sees it. You have an opportunity to get comments back from the SEC. You'll respond to the SEC either by making edits to the document or just responding back, and this is whatever. So you can go through different rounds, multiple rounds of filings that are confidential, and eventually you'll get to a point where it's not confidential. So this is something that has been kind of a recent allowance for companies to be able to go public and put out documents and slowly, right, and get their process down and ease their way into their filings. So, but just real quickly on the EGC and SRC, another fantastic one actually allowance by the SEC is that instead of 3 years, you can file just 2 years. So these are the types of things that these types of statuses help companies that are essentially trying to get off the ground, and especially startups to go public. And we think it's great.
Got it. So I've got another million questions I want to ask, but I'm seeing the moderator tell me, Levine, we're getting close, but I hear these buzzwords, fair value accounting, or how do I value my portfolio of investments, John? And from a financial perspective, how do you evaluate a portfolio of investments?
Well, arguably one of the few things in the world of finance I'm more passionate about than zero-based budgeting is portfolio evaluation. And so I'll keep this very brief. We could probably spend an hour on this, even at an introductory level. But the framework that we preach at Paro all starts with a current state gap assessment, where if we're starting to automatically dive in and say, what should we invest in, whether it be a product or a go-to-market, we've put the cart before the horse. And so really taking stock, ideally with an independent, experienced professional, to score the business. How do you compare to benchmark? How do you currently compare to your strategic goals? What's a laundry list of ideas and recommendations, and get it all out there. And then we quantify. And we actually look at, well, even if we're doing t-shirt sizing, what's the small, medium, large impact? What's the cost to achieve? Small, medium, large, what's that net to? What's our ROI? And so now we can start to understand, well, what are we hoping and do we confidently believe we can achieve with any initiative? Now we have the chance to prioritize. There's no right answer here. There's no magic wand. Sometimes there are dependencies that must come first. Other times it's truly at management's discretion. Are we looking for some quick wins from low-hanging fruit? Are we looking to optimize for the maximum ROI, the biggest wins first? Again, it's at the discretion of the company themselves. But with this prioritization, now we can progress to road mapping. Now we can progress to execution. Now we can actually track these portfolios of investments thoughtfully with actual goals in place and hold ourselves accountable. Hopefully that was quick enough and not way too much.
That was good. Yeah, that was good. So we have a couple other, few more minutes. We've seen a lot of cannabis companies, I guess, come out of Canada, and we've seen CBD and some mining companies. What other companies, coming to this conference that we've seen either trying to go public? Is there some, and I'm asking this to both John and Ro, what have they seen? I know we just were engaged by a huge telecom company. What I'm bringing out, it's not just the old mining and cannabis companies. What have you seen, John?
Everything from multifamily real estate to consumer goods to technology, which for some reason people sleep on, but technology is still a major driver of these IPOs, whether they're software providers or hardware. So it's about as agnostic as you could think. And I think that's very different than public perception. I'm curious what you're seeing, Ro.
Yeah, no, I'd say something very similar. I mean, Look, it's a full gamut, and I think rising water, whatever the phrase is, lifts all boats, right? So definitely a lot of tech. I mean, I'm seeing a lot of software as a service clients out there, and I think one of the key things. So one of the reasons why I think we're seeing it is because they're looking for this. So investors are looking for this monthly recurring revenue, essentially, where there's a lot of money there that I think investors think they can make, and so a lot of tech, biotech. So we're seeing a full gamut, honestly.
Got it. So to wrap up today, Jon, if somebody out there, one of these companies, want to get in contact with you, how would they do that?
Well, anybody can visit our website. It's paro.io, paro.io. You fill out a lead form, we'll have a highly trained financial consultant reach out to you. But for those esteemed few or esteemed 75 or so on the call, I'd love to actually have a chance to connect with you one-on-one. I'm the VP of growth here, oversee our sales, customer success, and revenue operations teams. I've consulted 2,000 clients. If you want to reach out to me directly, it's just jon@paro.io. Would love to give you the white glove treatment, and whether we're the right fit for you or not, I can certainly commit to providing as much value as I can and point you in the right direction.
Great. Ro?
Yeah, so you can find me. Look, I'm with Neil. Our website's friedmanllp.com. My email is rsokhi@friedmanllp.com. And again, as Jon mentioned, I'm really looking forward to speaking to all of you one-on-one. I think there's a lot that, even if we're not your auditors, we can guide you in some way, right? Either now or in the future. One final way you can find me is just, search my name in LinkedIn. I'm probably the only one that you'll find, and looking forward to having a great conversation.
Great. And if Mr. Kraft is out there, take it away, Bobby.
All right. Well, thank you all for joining us today for today's panel. And, if I don't speak to any of you before the new year is up, have a great new year, and we'll see you in 2022.
Okay, guys, thanks so much.